This video is going to deliver two big takeaways. First, it's going to tell you the secret tactics that private banks use to squeeze money out of your account through lesser known fees. And second, it's going to tell you how to negotiate significantly lower fees with private banks by leveraging one very special relationship that most people completely overlook. But before jumping in case you're wondering who I am and why I'm qualified to tell you any of this, my name is Chris. I'm the head of banking relationships at GlobalBanks. We solve cross-border banking problems for investors and entrepreneurs, including helping them establish relationships with private banks and wealth managers around the world. I spend my time talking to private bankers, including the heads of private banking divisions at some of the most prestigious banks in the world, looking to understand how they can better serve our clients, the types of clients that they're most interested in, and how the super wealthy leverage private banking to make even more money. And in case it isn't already clear, this video is all about private banking fees. So let's start with a fun fact, which is that up until the mid-2000s, no one really cared about the kind of fees that private banks charge, especially in Europe and especially in Switzerland. And the reason for this is that many banks offered something called secrecy or anonymity. Basically, they take your money and not tell the tax authorities, so your money would effectively grow tax-free outside of the tax system. And as a result, private banks, they could get away with charging whatever they wanted. Because no matter what they would charge in terms of fees, it would be a lot lower than what the account holder would have to pay in terms of taxes in their country of residency. Well, it's not the mid-2000s anymore. Secret accounts are long gone. So private banks, they can't get away with charging the kind of fees that they did in the 90s and the 2000s. Now, they need to offer value and come up with more creative ways to help their clients optimize their taxes and finances. Of course, if you're a prospective customer, that's good news. It puts you in the driver's seat and means you have leverage to help shape your private banking relationship if you're an attractive customer. What makes an attractive customer is going to vary, but for the purpose of this video, let's assume you are an attractive customer for private banks. And for reference, to start considering private banking, you should be looking to deposit at least $500,000 in terms of a relationship balance, though $1 million to $3 million is a much better starting point if you want to have any influence over fees. Now, I'm actually going to be releasing a complete breakdown of private banking very soon. This is going to include a walkthrough of how the super rich leverage private banking to make even more money from their accounts through creative financing, various lending solutions, and other wealth management products and services. So if you have any interest in private banking, make sure you subscribe so you get alerted when that video gets published. Okay, so private banking fees. What are they? What do they mean? And how do they impact your banking relationship? Well, there are 9 types of fees that you need to be aware of when it comes to private banking. I'm going to share each of these with you and tell you a proven strategy to negotiate lower fees for your account. And the first category of fees that you need to be aware of in private banking is transaction fees. These aren't your standard checking account transaction fees though. It's more like a Chinese finger trap. You can easily put your money in, but it's going to be painful to try and get it back out. Basically, many private banks, they won't charge you for incoming transfers at all. And that's very different than your standard commercial bank that may charge you $15 for an inbound wire, depending on where it's coming from. Instead, private banks, they'll let you bring in as much money as you want for free. Though when you try and withdraw your money from a private bank account, you can usually expect to pay 3 to 4 times more than you might at a normal commercial bank. Not to mention foreign exchange fees, which can take a bite out of the total value being transferred. So don't overlook the outbound transfer fees when opening accounts. Okay, the next fee that you need to be aware of when opening private bank accounts, it's trading fees. No surprise, if you have a private bank account, you're likely going to be investing in listed securities, stocks, bonds, maybe some crypto. And every time you place a trade, your private bank is going to get paid for facilitating the trade. Now, thanks in large part to low-cost trading platforms, a lot of private banks, they have significantly reduced their trading fees, though these fees are still charged at a lot of private banks. This is especially important if you decide to use discretionary management, basically if you're having the bank manage your investments for you. If that's the case, you'll be paying fees for the bank to manage your funds and fees every time they trade for you. And that brings us to discretionary management fees. Now, like I just shared, discretionary management fees, they relate to the bank actually managing some or all of your investments. These are fees that the bank charges you to manage your money. Quick pro tip here, if the fee that the bank presents to you feels low, say 0.25%, don't get too excited, at least not yet. You first need to confirm how that percentage is actually being calculated. In short, is it being calculated on the total relationship balance of all your accounts with the bank, or is it only based on the amount allocated to discretionary management? This is super important and can make a huge difference in the amount you end up paying. Quick example. Let's say you have a total relationship balance of $4 million with the bank, and you've allocated $1 million to discretionary management. The bank proposes 0.25%. Well, if you're paying 0.25% on the total $4 million, you're actually paying 1% of the amount allocated to management, which is a big difference. So you need to make sure that the fees being charged for discretionary management are clear. Are they being charged on the total balance of your accounts with the bank, or are they being charged on the total amount that you've allocated to discretionary management? Now, what if you don't want the bank to manage your money, but you still want advice from the bank? Well, this is becoming a lot more common, and it's where you're going to find active advisory fees. Depending on where you go, active advisory, it can go by a different name, like investment advice mandate or various other client advisory labels. Depending on the bank, this can include access to various levels of advice, research, and support. Basically, what you're getting is a halfway point between the bank managing your money and you self-directing all of your investments. The amount you'll pay for active advisory, it's going to depend on the bank, but like all of the fees that we're discussing, it's negotiable. And I'm gonna share how to negotiate these fees in a minute. But first, if you appreciate this kind of deep dive in terms of private banking or even international banking, do me a favor. Give this video a like so we know that we should keep making more videos like this for you in the future. All right, let's talk about a big one, which is custody fees. Custody fees are all about your investments, more specifically securities. Quick rundown on this. When you buy securities through the bank takes custody of those securities on your behalf, and the bank also handles disposition and redemption of securities, along with settlement and closing, and dividend and coupon collections. To facilitate all of these activities on your behalf, the bank is going to charge you a fee. That fee, it typically ranges between 0.1 and 0.5%, but as always, it depends on your relationship with the bank, your expected level of trading, and your overall relationship balance. All right, we have 4 more fees to quickly get through, and the next one is investment fees. Basically, these are fees related to specific investments that you choose or your banker chooses for you in discretionary management. Think funds with initiation or exit fees, management fees, performance fees, and lots of these investments, they have higher than normal commissions. And you need to know what these fees are before you enter or exit an investment. Quick pro tip here. If your banker suggests investing in various alternatives like private equity, hedge funds, or venture funds, you can expect higher fees than normal. And that's fine if you know the strategy you want to pursue. The point is, you just need to be aware of what you're getting charged to enter, participate in, and exit certain investments because it can dramatically change the economics of that particular investment. Speaking about investments in various funds, let's talk about retrocessions. Now, a retrocession is just another name for a kickback. And a lot of alternative investment vehicles, they pay kickbacks in the form of commissions to whichever party introduces the capital to the investment vehicle. This is super common in the world of finance. Companies do this when they need to raise capital, and investment funds do this when a bank introduces new investors. Now, certain private banking jurisdictions, like Switzerland, they've taken steps to protect investors against retrocessions, going so far as to require banks to repay past retrocessions. The point is, you need to be aware of this and make sure the private banks you're considering have your best interest in mind and aren't promoting investments that pay them a healthy commission. All right, jumping back to trading again, I want to talk about markups and markdowns. Basically, these are fees that private banks charge when they're acting as a principal in the trade. They either mark up the amount that you pay when you buy securities or mark down the amount that you get paid when you sell securities. The spread between the price and what you pay or receive is another way that private banks can pad their revenue. You can look for these in your mandate or ask your private banker to explain under what circumstances markups or markdowns might be included. All right, the last type of fee to discuss is fees for in-house funds. No surprise here, in-house funds are funds that are managed directly by the bank or asset manager that you're dealing with. And this can have a major impact on the amount of money that you end up paying overall, because these funds can have separate management and performance fees that get layered on top of the fees you're already paying to the bank. On top of that, because these funds, they tend to have a captive audience, meaning the bank can just sell them to their own clients, they may have higher fees than funds or other investment vehicles that are being ran by independent managers. Okay, those are the main fees that you need to be aware of before signing a private banking mandate. Now, before I share the tactics to start negotiating lower fees, if you haven't already hit the like button and you've made it this far in the video, make sure you do so that we know to keep delivering more private banking videos like this for you in the future. Okay, negotiating private banking style. Now, this is not going to be your usual negotiation. The banker you're dealing with is not your enemy. In fact, I want you to think of your banker as your man or woman on the inside, because that's who they are. They're going to help you navigate this whole process. And the reason they're going to help you is simple. They're not in this to squeeze pennies out of your pocket. If anything, a private banker, they want to make you happy and keep you happy because their focus is on establishing a long-term relationship. Actually, quick sidebar here, if you've made it this far in the video, here's a major insider tip. every private bank has a set amount of money that they look to generate off each client. And as long as they generate that amount of money, they're usually happy. I only say usually because of the various risk factors and complexities of different clients that can increase the onboarding and maintenance costs for the bank. But putting those extra costs aside, this is a pretty standard rule for most banks, at least private banks in traditional banking hubs. And that means everything is negotiable, and both the bankers and the bank are willing to work with you to come up with a custom solution that will benefit everyone involved. Now, the exact number a bank is looking to generate, it will depend on the bank, but it can be anywhere from a few $1,000s per year up to tens of thousands per year. And like you probably guessed, private banks, they generate money across all the fees that we just covered, which is why you have a lot of different ways to approach negotiations and ultimately agree to a mandate that best fits your goals. Of course, if you're looking to make use of other private banking products and services like creative financing solutions or lending products, then banks will be even more open to negotiating with you because you'll be an even more profitable client for the bank. Now, if you're a client at GlobalBanks, we can help you through this process by providing general guidance on how much the bank is looking to generate, provide suggestions on areas where there is more room to negotiate with the bank, and even suggest banks that are better suited to your preferred fee structure. Though really, all of that will depend on how you plan to use the account, your overall risk profile in the eyes of compliance, and the type of relationship balance you're looking to bring over to the bank. In terms of actually negotiating, it's best that you take a warm approach. Be clear about the fees that you're not comfortable with, the specific fees that may be too high for your liking, and ask your banker to work with you to come up with a plan that will work for everyone. If they say no, I'll be completely shocked. In fact, we've only had that happen to one client, and he had a very high risk profile that banks were struggling to deal with in the first place. But as long as you're not an outlier, you'll be fine. And quick reminder here, if you're still watching, you'll definitely get value out of the upcoming video where I'm going to be doing a deep dive into private banking, when private banking does and doesn't make sense, and the various ways that the super wealthy, they leverage private banking to make more money over and over again. If that sounds like something you're interested in, make sure you hit the subscribe button so you get notified when that video is published. In the meantime, if you want our team to guide you through the process of selecting the right countries, banks, and even bankers to meet your private banking goals, not to mention direct introductions to help expedite your onboarding process, check out globalbanks.com/insider. I've also asked the team to provide a link to our free private banking guide in the pinned comment below, so be sure to grab your copy. And if you're in the mood to learn even more about international banking, here are the 3 strategies that our clients use to open accounts remotely every time, especially in private banking.